Hello, accounting scholars, and welcome to Chapter 9, Section 2. Hey, we're going to continue on with the inventory part of manufacturing, and we talked about direct and raw materials. Now we're going to talk about work in process inventory. And as I mentioned earlier, the acronym for this is WIP. The cost accounting guys in a company will use that term frequently. So if you end up going to work for a large manufacturing company, that will be a term you will hear frequently. But work in process inventory is just that. You know, it's the goods that are in the production process. And so the T account here shows some transactions that would likely occur there. And so, you know, in a T account, you would have the cost of products that were started in the work in process inventory but not completed. And then you would debit work in process inventory as you would have increases in direct materials and direct labor, which are used in production, as well as manufacturing overhead, which is used in production. And that's would be indicated here by that 19,000, 5,700, and 7,000. And then, of course, when you actually complete the goods, right, they move from work in process inventory to finished goods inventory. And so you would have a credit. And that's what's showed with the 26,900 here. So the balance at the end of the period here is approximately $10,000 in work in process inventory. Okay, so a similar kind of thing goes on with finished goods inventory. In this particular T account, which is a finished goods inventory account, the same kind of activity occurs. You know, you would have a starting balance, which would be the cost of products that are in finished goods inventory at the beginning, but have not been sold, right? And then as you add new finished goods to this particular account, you know, you'd have increases, and that's what's reflected with the 26,900 when goods are transferred in. And then, of course, as products are sold, right, you would have a credit and a decrease, and that would be, in essence, another term you're familiar with is cost of goods sold. And therefore, your balance would be, of this particular account, would be $15,000. So you have your raw materials or direct materials, you have your WIP, work in process, and then you have your finished goods inventory. Okay, so let's move on now. So one of the, you know, just as we kind of talk through the expenditure accounts and additions and delete, you know, and subtractions, kind of the same thing goes on with inventory accounts. So you would, you know, in the direct materials account or the raw materials account, you would have a similar type of mathematical relationship to going on, right? And you basically saw that in those T accounts. You'd have a beginning balance of materials that have not been used in the previous period. You would add purchases. Then you would add the cost of goods available for use. I'm sorry, that would equal cost of goods available for use by adding the combination of beginning direct materials inventory plus purchases. That would equal cost of goods available for use. Then if you would subtract the direct materials issued into production, and then you would have your ending balance or materials not used in this particular period. So if you move on then to the next inventory account, which is WIP or work in process, you would have a similar type of relationship going on. Again, you'd have your beginning balance of work in process inventory. That would be, the costs associated with those products that have been started but not finished in the previous period. Then you would add direct materials that were used in the production process. You would also add direct labor, which was used in the production process. And then you've got to add that manufacturing overhead. Again, manufacturing overhead are those particular costs that aren't directly related to the product. That could be, the factory utility costs, the director of manufacturing salary, those types of things. Then that would equal the cost of goods that are defined as in process, and then you would subtract the cost of goods manufactured, or actually the cost of goods that have been finished, and that would give you your ending balance of WIP or work in process inventory, and that would reflect the cost to date of products started but not finished during this period. Again, that's the reasoning for the name work in process. It's stuff that has been started in the manufacturing process but has not been completed. Okay, so then let's move on to finished goods inventory. And finished goods inventory, the math here is, again, very similar. You'd have your beginning balance, which reflects the cost of products finished but not sold in the previous period. Then you would add the cost of goods manufactured, and that total, or that sum, would equal the cost of goods available for sale. You subtract the cost of goods sold, and then you would have your ending balance, or the cost of products finished but not sold in this particular period. Okay, so we've pretty much covered the various types of inventory and how to calculate beginning and ending balances of those inventories. So we're gonna stop it here before we move on to the manufacturing overhead section. So have a good night, guys, and we will see you tomorrow